Hi and welcome to Khaleej Times. My name is Rube, and continuing with a podcast series on financial planning. Today's episode addresses something that we all struggle with, which is, overcoming our emotions when it comes to trading, because we all fear the highs and the lows and losing money and so on and so forth. Now, to address that, I have someone from IG, Mr. Monte Safeiddine. He's a market analyst at IG. It's an exceptional platform where you can transact or you can trade in over 16,000 financial markets. Monty, welcome onto the show. Thank you so much for being here with us.
Thank you. Glad to be here.
Okay, so of course, my first question is, what do you mean by trading psychology?
Well, a lot of times it's more about, before you enter into trading, what exactly do our emotions have to do with it as human beings? So before you get into those decision-making process and the skills that's required and the experience and all that kind of stuff, what exactly is my psychology saying? What is my intuition when it comes to greed and fear saying before I enter into the financial markets, before I even place a trade? And that really is something that needs to be mastered before we even go into the idea of, okay, well, what skill sets or strategies or all those type of other fun stuff.
Wow, it seems easier said than done. How do you, we all go through these set of emotions. We all feel fear, we all feel greed, we all feel, like you said, that we have our doubts, right? I remember that my dad is actually into trading, and he keeps pursuing me to sit down and learn a little bit about it, and then, that it's high time that I should start investing and so on and so forth, that I'm just so fearful, and I'm sure there are a lot of people out there who probably feel the same set of emotions as I do. And most of the times when you have fear of losing, you don't end up investing, or even kind of, being open to the idea as well. So how do you kind of tackle these emotions, since you're...
Well, I think part of it has to do with discipline, of course. You want to be disciplined whenever you want to enter into the marketplace, or when you want to do anything in general in life. You want to have that sort of discipline. You don't want to just say, it's not something you want to do on the fly. And I know we're talking about trading, but it's also something you apply towards business, towards, if you're looking to purchase real estate as an investment, it's the same concept. You kind of want to remove the emotions, or try and remove the emotions before you go ahead and make that decision. Now, because you're making so many decisions when it comes to trading, if you're day trading, for example, you're going to be making a few trades every day, minimum. You could, of course, opt to do only one per week, but you'll be doing a lot of trading per day. And that means that you're going to be going through a lot of ups and downs depending on how your trades are doing. So a good way to do it is that you want to tell yourself ahead of time, before you even initiate a trade, look, this isn't the trade, because a lot of times greed can also play into it, where we think to ourselves, oh, this is the one, I'm going to be a millionaire off of it, this is the business that's going to make me a ton of money, and you're putting all your emotions into it right off the bat, just by you saying that, you're putting your emotions into it. And that's the wrong way to go about it. Not just in trading, it's the wrong way to go about it when it comes to investing, or when you have a startup idea or anything. So you want to take away the emotions, and you want to look at it from, unfortunately, a numbers point of view, which I know not all of us want to do sometimes, or not all of us might even excel at it, but it is something that we need to do in the sense that you want to take away the emotions, and you want to go ahead and look at it from a risk-reward point of view. Of course, if you're a trader, or if you decide to trade, you also want to keep in mind a bunch of other factors, which I'd be happy to.
Okay, perfect. Since you're talking about the need to keep a very pragmatic approach, towards trading, right? But in life, we attach these emotions to pretty much everything. I'm just thinking to myself that, is there like a rule book that makes it kind of, easy for you to take away those emotions, like take away the greed, take away the fear, be a little more practical, be a little more pragmatic, and is there a set of rules that we can follow?
Well, I'll say, let's start with, ideally you want to be aware of that flaw. And what I mean by that is that a lot of times in the markets, the way the market moves sometimes runs contrary to our psychology. So let's look at it from a psychology. How do we react when we make money? How do we react when we lose? Our psychology of how we treat rewards versus our psychology of how we handle losses. To make it very simple, so let's say you put in a trade and you're making money. and the market starts to retrace or even wobbles just a little bit. So it goes in your favor and you feel really good, obviously, because, hey, look at that. You open a trade and bam, you're making money and you're getting excited because, again, if you put your emotions into it, you're getting all happy and you know, the air feels fresher. You know, you look in the mirror, you feel like you look better with the same clothes on. It's that psychology of it. But the moment it starts to wobble the market, the moment it starts to retrace, what do? You want to close that position. And a part of that has to do with the fact that we as human beings, we don't want to seek risk when it comes to rewards that are in the bag, so to speak. So if you had a choice between, let's say, you know, a guaranteed money, you know, let's say, you know, guaranteed $1,000 versus a business with a 50% chance of giving you $2,000 a month. Now, by default, we don't want, you know, we have fixed obligations. We don't want to take on that risk when it comes to that reward. We go, you know, I'm just going to stick with the guaranteed $1,000. Even though on average, you're making more in the second scenario, on average, over time. Yeah. But it has to do with the fact that we prefer that fixed amount because we don't want it to seek risk. But that's the opposite when it comes to losses. When it comes to losses, if you open a position and it goes against you, or if you're holding a business and it's losing, we have trouble letting go of it. And in fact, we're willing to add more to it, more money into that position. We're willing to add more of our resources and, yes, more of our emotions in the hopes of avoiding a loss. So we actively seek risk to avoid a loss, but we avoid risk when it comes to our returns. And this actually works contra, and this hurts us when it comes to the average market movement that we experience.
All right. So would you say that okay, so, you know, how would somebody, especially, you know, if someone is new, someone is starting out, what do you think is the best approach to trade in a stock market? Like, how do you think one should, you know, kind of start out?
Well, first off, obviously to be aware of our flaw in the sense that we have a tendency to let our losses ride. So if you buy a stock, for example, you love a certain stock and you love the stock of Apple or something, you want to buy that stock, so you buy it and then it goes against you. We have a tendency to say, okay, you know, it's going to come back, let me hold on to it. And we take on big amounts of losses. That runs in stark contrast with if we open a position, we buy Apple, for example, and it goes in our favor. What do? We automatically close it. So by default, we're willing to accept a lot of risk for a very, very small reward. So you need to be aware of that. You need to say, okay, I need to avoid doing that. So you need to set yourself up mentally to tackle that psychological issue and say, you know what, okay, by default, I like to take on additional risk when I'm losing, but I need to break that link. I need to say, you know, okay, I need to actually take on less risk when it comes to losses, and maybe consider more reward when it starts to go in my favor. And that really is something that's going to take a lot to overcome. But I think a part of it, of course, is to be aware of that flaw. It's not something that just exists with you know, if you've traded for the first time. It exists with many other traders, professionals,
So Monte, we're talking about, you know, these various set of emotions that we feel in almost all aspects of our life, including, you know, when it comes to trading or investing. Which one do you think influences the most? Is it the greed or the fear or the gut feeling? Like, which factor do you think sort of sways us the most?
I think it really depends on how we've been doing. You know, if you're doing really well in life, and, you know, it's the same thing with business. You know, if you open a business and it does well, all of a sudden you become a bigger risk taker and you become greedy and you go, you know what, you start looking around and you start looking for more opportunities, even opportunities that aren't there, because you're hoping you just made, you know, a lot of money, you've just been successful right off the bat, so you're thinking, oh, here's my chance, let me go out there and find something else. Same thing when it comes to trading. You know, it depends on how you've done recently, unfortunately. It shouldn't be like that. We're supposed to be consistent and disciplined, but we have a tendency to say, oh, how did I do recently? Did I initiate some good trades? Oh, great, now I'm going to take on more risk, and you become more greedy. So that greed starts to influence you depending on how you did on the previous few trades, because we have a tendency to base our risk on how we've done recently instead of having a disciplined set of rules before we even go into trading. And when it comes to fear, same thing. If we've lost the past few times, or if you had a business and it lost, and then you open another and it lost, and then you open another business and it lost, well, what do you think is going to happen when you come to the...
putting your hands into it.
There you go. Or it's going to be very difficult to actually initiate something, and you're going to be very cautious, and you're going to be afraid. That's when the fear starts to kick in. So, and when it comes to, you mentioned gut feeling, one thing I noticed about the financial markets is that a lot of times you want to avoid gut feeling when you first start trading. And the reason for that is because of the fact that the market movement might be against our psychology of winning and losing. So if it's working against it, you don't want to trust your gut feeling initially. Maybe after you have experience and more discipline and you understand the financial markets more, then you can say, okay, now maybe I can start trusting my gut feeling.
But do you think that gut feeling actually ever works? I mean, because this is like I'm presuming it's all about numbers and it's all about data and it's all about facts and figures and so on and so forth. But do you think that even with experience,
well, you have
gut feeling?
Well, I mean, you have to calculate at the end of the day. So you don't use gut feeling on what your risk or reward should be, how much you're willing to risk, and on those numbers. But gut feeling in terms of where you think the market, whether or not the recent market move is, for example, going to sustainable or not sustainable. So gut feeling in terms of direction of what might happen. But yeah, of course, when it comes to risk and reward, you got to have something fixed there. You don't want to shift on that, or it could go against.
Absolutely. Okay. There's another element which I've seen a lot. Like the people that I know who invest quite regularly in stock market is also that the herd mentality, following the herd mentality. When do you think one should buck that, in the sense that I see someone else making a lot of money in stock exchange and I feel, okay, what, even I need to start doing that, or a certain person saying about something positive about a certain company, the way it's performing, or a particular share, and I feel that, okay, let me put my money into that. So how can we control that side of the emotion?
I think it shouldn't be about herd mentality. You shouldn't say, oh, others around me are making a ton of money, or I heard that others are making a ton of money, therefore I got to go ahead and hit it and do the same thing. Let's not forget that as human beings, when we're making money or when you're trading, or if you're making money from trading or outside of trading, we have a tendency to kind of show that off and talk about it, and say, hey, I've seen that a lot, especially with other traders and stuff, when they're doing real well, like, hey, they're smiling, they're outspoken, they're walking around, tapping you on the shoulder, hey, what's going on? They're just in a much better mood, and they're willing to kind of tell people about that success because they've attached their emotion to that trade when they should have never attached it in the first place, and vice versa. When they're not making any money, you don't hear about them, and you never saw them. It's like, hey, how come I never, no missed calls, no messages, what's going on? So that's kind of how you have to look at it. Like, hey, when things are going well, you're going to hear from them. When things aren't, you may not hear from them, and that's, as a trader or as someone who wants to go into invest, whether it's trading or investing or in business in general, you need to avoid that. It shouldn't be based on what others are doing or the success that you think is occurring amongst others, and say, oh, I'm going to base it on what they're making money, I need to get out of this and start making money. Yeah. To the contrary, you need to maintain your consistency in whatever it is that you're doing in your own job, in your own work. Maintain that consistency and then build up. If you want to go into investing, if you heard about a stock, then look at it from an objective point of view and say, okay, should I buy it or should I sell it? If it's a CFD, you can short it if you think the price is going to go down. So you can. That's the proper way to do it. To do your homework and to go in a much I should say, to pace yourself before doing something like that. Because I have to say, when people tell me about the money and all that kind of stuff, you start to get excited and go, oh, I got to hurry up. I got, this, and then someone with a Ferrari drives by at the same time, and you think it's karma, or something, all the signs that the wrong signs we have a tendency to get. Yeah. So yeah, exactly. Someone's flashing some bling or something. You're like, oh, but that's it. That's it. I'm going to go into it. And then you put all your money into it, and we all know the end of that story. So
yeah. So that means, if you see a car passing by that says 777, please, that does not mean that you need to start investing. It's funny enough, I'm again and again going to my dad, because I know that he's deeply interested in financial planning. He reads a lot about it, and then he himself sometimes trades.
Well, it's an exciting topic. I don't blame him. It's a very exciting topic, and it keeps you always want to be ahead in terms of the markets. But sorry to disturb. Go ahead. You were about to get to a really important point.
There's a joke about him, which is if he's happy, that means the stock market it's a bullish market. That means that something great has happened.
So he must be very happy recently.
But if he's sad,
okay.
No, I'm sorry. If he's happy, there could be plenty of reasons, right? But if he's sad, means it's a bear market. The market has crashed. That's the only reason why he's feeling sad.
Well, it's good. It means though he shouldn't have been sad very very recently, because the U.S. indices have been on a roll going up. So hopefully he hasn't been sad very recently. Yeah, I know. Once they start reaching for the medicine cabinet, something's wrong, right? It's like, whoa, wait, what happened? It's like, oh, bad trade or something, or a series of bad trades in a row or something, or market went against me, and we have all those sort of things. But I think that's why it's so important to minimize your losses and to plan for that ahead of time, so that when you take a hit, you've managed it. It's not you already have it planned out and already calculated. You go, okay, if it goes in my favor, and I think this is how it should be when it comes to business. You just go, okay, this is, I'm going to enter this trade. I'm going to buy gold. I'm going to buy the euro, for example, Euro USD. If it goes in my favor, this is the intended profit that I intend to make. If it goes against me, I'm not going to just hold on to it. I'm going to close it out there, and I'm going to accept that minimized, calculated loss, pre-planned. And that helps the emotional state going into it, because now it's already planned ahead of time. It's not a matter of, oh, is it going to go in my favor? Is it not? You know what? It may not. That's how the market works. You did your homework. You put in your trade. It went in your favor. It didn't go in your favor. That's the end of the story. And you really simplify it. And I know as human beings, we don't want to do that because we want to put our emotions into it. Let's face it. If a trade goes, if you do well in a business or something and your emotions was in it, it's more exciting than if you didn't put your emotions into it, right?
Absolutely. And I think one needs to also understand that, that's a part of the game. Like, this is what the nature of trade is. I mean, you do lose money. Even the best traders in the world, they suffer from loss.
Oh,
right?
big
So
time.
It cannot be like a win-win situation.
Yeah, I've seen hedge funds. I've worked with hedge funds. I've seen professionals, the guys who've been at it for decades, and they've gotten it wrong. But I think the difference between when they got it wrong, the professionals, and when someone who isn't professional got it wrong, is that they calculated, factored in, and managed that loss. I mean, even if you look at it from a business point of view, all the successful billionaires around the world, I would not be surprised to see a lot of them were on the verge of bankruptcy at one point in their lifetime. That's just the nature of the business. But I think it's about how they manage their losses, that if a loss comes their way, how do I manage it? It's not like, oh, if a loss comes my way, I'm going to put everything into it to try and avoid the loss. If you do that, you're guaranteed to lose at least one, where you're going to lose everything, because you're putting everything into it. And that's not what you should do on a trade when it comes to.
It's interesting, Monty, when you talk about managing the loss, do you mean that, that's where risk management also, comes into play? Is it the same thing?
When it comes to risk management, you're basically quantifying the loss, the gains and the losses. So when we talk about psychology, we're talking about how we react when it comes to losses, how we react when it comes to gains. And when it comes to risk management, it's about quantifying it, putting a number onto it. We don't always want to put numbers onto things, but that's kind of how it is. And that's when I say that if you initiate a trade, for example, you want to quantify and put a number on it and say, okay, if it goes in my favor, how much do I want it to go in my favor? If it goes against me, how much do I cut it loose and say, okay, enough is enough. I'm not going to lose any more than this. So you're putting a number on it, a fixed amount. So for example, 20 points in my favor. If it goes against me, 10 points, and you sort of manage it accordingly.
Which I think is absolutely crucial, because I don't see any other way actually of doing it, right? Because you can't really quantify your emotions. I mean, you're always going to feel the greed and you're always going to feel the fear and so on and so forth. But once you start quantifying it and putting like a number to it, it becomes easy to kind of accept or manage. Like
exactly, because now you can actually say, okay, if I lose, I'm losing exactly this amount. If I win, I'm making exactly, that's it. Whereas if you go into ahead of time and you have no idea about numbers, it's either I win or I lose, and that's it. And you haven't quantified it at all. And what will end up happening is, if you don't quantify, if you don't put for example, a stop loss to try and minimize your losses on a trade, what will end up happening is, if you make money, you'll make a little bit, because we try to avoid risk when it comes to rewards. So if the market moves in favor of our share price, we automatically close it and we're done. We're like, I made money and I won, and yes. But if it goes against us, we hold on to it until it could wipe us out completely. So when we look at it from a psychological standpoint, a win or a loss, and we don't put any numbers on it, what it really means when we translate it into numbers is that if we win a little, and if we lose a lot or everything. And that's so dangerous. This is why it's so important to put to quantify. And let's face it, nobody wants to think about a worst case scenario. Even if you're going on a road trip, you're not going to think about your tire going flat. You don't want to think about your engine going bad to go on this long road trip. But you do need to be prepared for it. So there's a difference between constantly thinking about. You don't want to think about it all the time. Oh, I could have a flat tire. If you do that, you'll never go anywhere. You'll be stuck at home and you'll never travel at all. You don't want to always think about it and be stuck in that spiral, but you do need to be prepared for it. Okay, if my tire goes flat, this is the number that I need to call for towing or for the tire guy or the battery or whatever it is, and hopefully it's not something bigger than that. Yeah.
Okay, so as we're also talking about managing losses, risk management, so on and so forth, and quantifying, putting a number to things, which makes it easy for you to keep that practical, pragmatic approach, and not get swayed or stuck into emotions and then end up not doing it at all. But before we actually talk a little bit more about risk management, let's sum up the whole thing, again, the investment psychology and the psychology that plays behind trading. So if I have to ask you, what are the things that we need to remember in terms of psychology when we start trading or start investing? What are the most crucial aspects or key points that we need to remember?
First off, don't put your emotions into it. So basically, I know it's the psychology of trading, but don't put your psychology into it. Try to take your psychology out of it, which is difficult to do, I agree. But second of all, you obviously want to know how to limit your losses. That's the crucial thing. I don't say limit your gains because by default we already do that. Our psychology is already designed to limit our gains because we don't want to take risks with our gains. So if it goes in our favor and we see it coming back down, we don't want to go back to zero. Nobody wants to go from positive to zero, so you want to go ahead and close out. There's of course another aspect, and that is the satisfaction that we get from a gain versus the dissatisfaction, the emotional dissatisfaction we get from a loss. So if, for example, I were to give you $100 right now, your satisfaction goes from here to here. You go up in satisfaction, I would hope, right? Because you're up $100, you're thinking to yourself, you feel good, and then you see you're smiling, you're already feeling good about it.
Yes.
And you're up.
Are you seriously giving me $100?
I'm going to take it back away from you for the sake of the example, but let's assume let's start with the fact that I give you the $100, you move up and you're feeling good about yourself right now. Now, if I turn around and I take away that same $100 from you, you will not go back down to here where you started. Exactly. You're feeling actually worse. You actually go down. And the reason why is because the satisfaction we get from going up is less than the dissatisfaction we get from going back down. So even if you started at zero and ended at zero, you're thinking to yourself, oh, then he or she should feel just fine or the same as when they first started. Absolutely not. Especially if you're holding that trade, for example, for a very long time. Now you've invested your emotion into it. You've invested your time into it. You've invested money into it. So the last thing you want to do is come out at zero, and to watch a gain go back to zero or even negative, that's one of the worst feelings, of course. So that explains the reason why we have a tendency to want to close a position in profit as soon as possible, even though it might be at a greater risk. Like it might be better to let it ride sometimes, depending on this.
Okay, so again, patience is the key. So you need to kind of
I would say patience is one aspect. So one exercise I like to do was I would open up a trade, and if it goes into loss, I would close it right away. And if it goes into profit, I would hold on to it, even if I thought the market was going to come back. But I would like to hold on to it, and just to get myself used to the idea that, you know what, to fight that inner urge to close it, to fight that inner urge to say, I don't want to seek risk. I want to avoid risk when I'm making money, but to actively fight that by saying, you know what, if it's in profit, if I'm making money, it's okay, leave it open and start to take on more risk when I'm making money, and flip it and say, when I'm losing money, don't take on any risk. Because the opposite usually happens. I don't want to lose. No one wants to lose, right? I mean, you don't want to walk in the next day, it's like, oh, I lost. It even sounds bad, right? It's like, oh, I lost. I lost again. I lost a third time. It just sounds really bad, unfortunately. And that's us attaching a psychology to it and using our emotions.
Okay, just pardon my ignorance, because I have personally never really traded or invested, which is so unfortunate. I wish I had the money to do it, but maybe after this session, yes. But like you said, that in a stock market when you're trading and you know that the market is, that you're losing money on a certain share, so you're going to immediately close it. Won't you kind of wait? You never know, because it may just kind of...
Oh, a lot of times, on average, markets usually retrace. So whether it's going up, it could retrace back down. Whether it's going down, on average, you do get that retracement. But there's that one or two times where it just doesn't, and it trends opposite, and it trends opposite. And whether you know it will or whether you don't will is besides the point. When it trends opposite, on that day you will lose a lot if you hold on, and you'll make a lot if you hold on. So that's the reason why I was training myself to hold on with gains and to not hold on when it comes to losses. Of course, it's sort of teaching myself that skill set so that when I want to apply it, when I need it, I'm trained to use it. Because otherwise, if you always get yourself used to the idea that I'm going to take profit right away and let my losses go, now you've become accustomed to that. So you need to break out of that habit, because it's a bad habit. Let's face it, when it comes to trading, it could devastate your account. So it's something you want to avoid.
Okay. And would you say that, especially someone who's starting out, should do it by themselves? You think it is better to do it as a team? You think it's good to reach out to like a financial professional who can do it for you?
If you're trading with friends or buddies and stuff like that, it's obviously a lot funner, and you get to exchange ideas.
It may not be the best idea, but maybe a lot of fun. But a
lot of fun. But you get to exchange a lot of ideas and stuff. But I also know that I was once at a trading arcade, and I was sitting there. You had about 50 other traders from different parts of the world sitting with me and stuff. And when the market would go against a lot of the traders, you'd hear the swear word in a lot of different languages, and a lot worse than the one you mentioned, stuff that we'd have to bleep out, but hitting their chairs, smacking their stuff. So, and you could see the psychology of it in play on some of the traders that weren't as experienced versus those that were. Yeah, so you do pick up things from that, and you do get some advice here and there, even if tips and stuff like that. So I do think it's nice to at least, if you have like a social group or a group of friends that are into trading a little bit, to at least bounce ideas in terms of trading. I mean, they might say, hey, look, this is going to go up. Just because they say it's going to go up doesn't mean you should go all in, because chances are, it could go against. You have to go in with your risk reward ready and ready to go. Even if they say it's a sure thing, it doesn't matter. You have to have limits in terms of how much you're willing to risk when you go into it. But it is great in terms of bouncing off ideas back and forth, and especially if you can avoid the social stigma. Like when you lose, you shouldn't be like, oh, I'm not going to talk to anyone anymore. I'm gonna sit in my corner and cry myself to sleep. You don't want to do that. You want to be out there. You want to remain socialized and say, hey, you know what? I took a loss. So what? Yeah, I lost. The best guys have. Best businessmen have, the best guys in real estate, investing, everything. They've taken a loss. I had my stop loss. I took my loss. I limited it, and I move on. And now I'm looking for a new opportunity. And that's really the professional way to do it. That's really the proper way, the psychological mindset. Just say, hey, I took a loss. So what? I lost. Yeah, and
yeah.
Normally it's
and that's also the best way to overcome anxiety that you feel.
Yeah, of course, absolutely. With trading, it's the thing is with trading, it's happening more frequently. It's amplified. With a business, you open a business, it takes 6 months to a year, and you find out if it succeeds or fails. Real estate, same thing. You're waiting 6 months to a year before a significant price rise will occur. Trading, it happens the same day. So you're getting those series of wins or series of losses, or win-loss happening on a much more frequent basis. If you can control that, if you can master that, and it's more difficult, but if you can, then afterwards a loss means almost nothing. If you go, oh, I lost, man, big deal. I've been through a whole lot worse on a psychological, emotional standpoint. So I do think that's something to keep in mind when you're trading.
Yeah, I mean, the best way to do it is that you have to keep telling yourself, you have to keep reminding yourself that this is not the worst. Right? I mean, that's the way you can bounce back, right? I mean, you have to keep telling yourself that, like you said, the best of the traders, they lose money. This is the part of the game. This is the nature of the...
As long as you didn't set yourself up to lose everything, and that's really what risk management's about. You're losing a small amount. So if you risk just a very small amount, not your whole account, if you risk a small amount, you lose a small amount, and then you wake up the next day and you continue. But if you're every time you're saying, no, I'm going to put everything into it, my whole emotion, my whole money, and everything I have, now you're risking everything. So yeah, you could recover from it. I agree. The top guy, there are big hedge funds out there that went all in, they lost, and that would help you get out of that. But ahead of time, why put yourself in that situation? Limit your risk ahead of time. Otherwise, when you lose, you're just going to be in a bad situation, and you're going to, let's face it, you're not going to feel that great. You're going to be like, turn off the lights. I don't want to look at anyone anymore. Turn off the cameras. I can't see. I can't look. You get that sort of feeling, and that's something that you can really avoid from the get-go if you learn how to limit your losses instead of doing what our psychology says, which is just hold on for dear life till the very end.
Which also means that you should not be trading too much and too often, right? I mean, you need to be smart about it. You need to be selective about it, and you need to kind of, study the market or whatever. I mean, you need to, and then you need to see, okay, this is where I'm going to open my position, and so on and so forth.
You want to go in with a calculated approach. I agree. If you overtrade, if you trade too much, or if you trade with a very large size, for example, because you're looking for higher rewards, you get too greedy, then I absolutely agree. Then that's been one of the downfalls for a lot of traders, that they just overtraded. It's, make it simple. Take a step back. Take a deep breath. Look at it and just go, okay, this is my consistent plan. It's going to involve roughly, 3 trades a day, for example. This is what I'm aiming for in terms of reward. This is what I'm hoping to avoid. But if I lose, if it goes into loss, and it very well could, but if it goes into loss, this is the max I'm willing to lose, and this is how I'm going to go about doing that. And you just hit it from a very, very mature point of view, and you just stick to it in a consistent manner.
Perfect. So, when it comes to the psychology part of it, I know that you may have to practice it, right? I mean, this may come over a period of time once you get used to the fact that you will lose some money, and it is absolutely okay to do that. And if like you said, that you can sit down with a group of friends and you can bounce off ideas and you can trade with them, or you reach out to a financial professional who can do it for you. I want to know that, is there a set of rules that you need to follow, especially when you're working with a financial professional? who's investing for you, say for example, who's trading for you?
With a financial professional, it's going to have to be, we're talking then in that case more like portfolio. It doesn't have to do with trading, because with trading, for example, like in our case, we don't trade on behalf of the client. The client does the trading on their own. We may, of course, offer them the information that may help them aid in terms of their decision making. So we'll let them know where the larger traders stand, where the smaller traders stand, what different indicators are available. But at the end of the day, that decision making falls with the client. And anyone out there who says, "Oh, I can trade you, I can give you this insane amount of money," or whatever, a lot of times it's negative that. Whatever it is, if they're saying they can give you 30% returns, chances are it's negative 30 or maybe even negative 90%. But that's a lot of times you don't want to fall into that trap. So a lot of times as a trader, you have to take on that responsibility, I think. Now, investing or a portfolio, now that's something that's a different concept, but in terms of trading, that's something I think the trader has to assume responsibility for. And I think that with time, with practice, with understanding, whether you're simulating or whether it's live, that's something I think that you'll improve over time.
So you would say that, when you're trading, it is important to make these set of rules, and it is important to stick to them.
Absolutely.
Yeah. Thank you so much, Monte, for sharing, all the information with us. With that, it's a wrap on the first part of psychology of trading and risk management. However, we're going to continue the discussion with Monte in our second part, so do not forget to tune into it. And also, please log on to KhaleejTimes.com, where we have lined up 10 episodes on financial planning. Everything that you need to know about financial planning, you're going to find it right here. So keep tuning into KhaleejTimes.com, where you can navigate, you can explore, and you can listen up to all the 10 episodes on financial planning. Thank you so much for listening, and thank you so much, Monte.